Hello InvTraX. Forex trading, or trading foreign currencies, is a popular way for investors to make money. However, it is important to understand that it comes with a high level of risk. It may not be suitable for investors who are not comfortable with taking on risk. Before deciding to trade Forex, it is important to carefully consider your investment objectives, level of experience, and risk appetite. Only use surplus funds for trading, and never trade with money that you need for other things. One of the main risks associated with Forex trading is market risk. This refers to the risk of loss due to changes in economic and political conditions that can cause the price of a currency pair to move. For example, if a country's economy is performing well, its currency will likely appreciate in value, while a country with a struggling economy may see its currency depreciate. It is important to stay informed about economic and political events that can impact the Forex market, and to use technical analysis to identify trends and make informed trading decisions. Another risk is liquidity risk, which refers to the decreased availability of a currency pair due to unexpected changes in economic and political conditions. This can cause the price of a currency pair to move sharply higher or lower, or to be volatile. It is important to be aware of potential liquidity risks and to use stop-loss orders to protect your trades. Leverage is another risk associated with Forex trading. Leverage allows you to trade with more money than you have in your account, which can magnify gains, but it can also magnify losses. It is important to use leverage responsibly and to use sound money management principles to limit your risk. Technology and internet-related risks are also a concern in Forex trading. The failure of hardware, software, or internet connection can happen at a critical time of trading, which can cause significant losses. It is important to have a reliable trading platform and to have backup plans in place in case of technology issues. Fraud is also a risk in Forex trading. While the industry has cleaned up considerably in recent years, it is still important to be cautious when choosing a broker. It is recommended to do some background checks and to only work with reputable and regulated brokers. Exchange rate risk and interest rate risk are also risks associated with Forex trading. Exchange rate risk refers to the fluctuations of currency prices over time, and interest rate risk is caused by discrepancies in the interest rates of the two countries represented by a currency pair. These risks can cause variations in the expected profit or loss of a Forex transaction. Credit risk is another risk associated with Forex trading. This refers to the possibility that one party in a transaction may not pay the debt, and country risk is the risk that a government will become involved in foreign exchange markets by limiting the flow of currency. This can cause significant losses. In conclusion, Forex trading can be a great way to make money, but it is important to understand the risks involved. Keep in mind that high returns come with a high possibility of loss. Before diving into Forex trading, consider your investment goals, experience level, and risk appetite. Keep informed about economic and political events that can impact the Forex market. Use technical analysis to identify trends and make informed trading decisions. Be aware of liquidity risks and use stop-loss orders to protect your trades. Use leverage responsibly and use sound money management principles to limit your risk. Be cautious when choosing a broker and always work with reputable and regulated brokers. If you liked the video, let us know by subscribing to our channel and liking the video. Get free trading signals by joining our Telegram channel. Link is in the description. Have a safe trading journey.